I'm here on the floor right now with a guest who's going to talk to us about how to invest in what has become an increasingly volatile marketplace. Alvin Wilkinson, the founder and principal of Surveyor Management, is here with me, and you are the principal investor in this proprietary capital company. Tell me, how do you define volatility, first off?
Well, Margaret, that's a great question. The definition of volatility is probably in the marketplace one of the most widely used. Means different things to different people. If we look at the measurement of volatility, there's things called variance contracts, which kind of measure a historical movement of the underlying. And one area that you're probably familiar with is VIX. That's something I had a pretty good hand in formation in its early days. Is an implied option volatility. So therefore, let's say, for example, today the market's kind of dormant relative to where it's been the last few weeks. And all of a sudden you see the VIX being up. Okay, well, you would think that inherently that would be down. And in reality, there's probably people, because I haven't been looking at the market as of late, but people are probably buying some aspect of the put wing in 1 or 2 months out, 5%, 10% out of the money put options. Therefore, it's creating, because there's uncertainty still lingering out there in the world. What's going to happen in the European markets? Is the Greek financing thing really going to get resolved over the period of time that caused the rally yesterday?
Right.
So taking all those things into consideration, there are large institutions in the world that will use VIX contracts, or they'll outright go buy the S&P 500 index put options and those sort of things.
And we've seen volatility come down about 31% from the October high when you look at the VIX itself, but it's still really elevated.
True.
There are so many different ways to buy protection. How do you figure out the best product?
Oh, having been actively involved in North American indices, primarily the S&P 500, and those products are traded, at the Chicago Mercantile Exchange, and the futures options, the cash-settled options, SPX, and also the ETF options known as spider options. They're, obviously it's, if you have a portfolio or you just have a general concern about market movement, primarily on the downside, there are a variety of option strategies that you can deploy, and obviously there's numerous textbooks sold at all the bookstores down the street.
And there are 5, low volatility ETFs that have launched over the past 5 months. What's the benefit of an ETF like that versus the VIX itself?
I think there's some issues with the ETFs with regard to tracking error. If you look at the measurement where you can buy outright VIX futures, if it's suitable for your account, you can trade those, you can buy either one, but I find that sometimes the ETFs will overtrack or undertrack where the actual volatility movement is. So without getting directly buying S&P 500 put options or sell call options or something along those lines, you have those flexibility of going in and buying those ETFs if you're willing to do so. Generally, the rule of thumb that's out there right now is about 5% of your allocation to your portfolio might be considered, up to 5%, I should say, should be used to look to some sort of volatility component, depending on what that basket of those securities are and how they correlate to the markets.
Now, you personally right now, you're long further up the curve. You've got some long calls for November and December. Does that mean?
Oh, no. What I have is right now there's what's keeping the VIX elevated some. There are a lot of new funds out there. You've heard them. They're like the catastrophic funds that are out there, the tail risk funds.
Right. These
tail risk funds are go out and purchase options generally anywhere from 2 months to 4 or 5 months out, and they're way out of the money options. 20-25% on the downside or greater. And so inherently, being an ex-market maker down on the floors of Chicago, I would inherently sell those, and so do a lot of other people. There's always two sides to a trade.
Right.
And so what do? I'm just not going to be naked short those. So I will sell those thinking that if there's something further up the curve that I can buy on a potential ratio spread, buying one put option and maybe selling 2 or 3 way further down, and try and do that for delta neutral or dollar neutral. Delta neutral. If I sell a put, you want the market to stabilize or go up, generally. Okay. If you don't want it to catastrophically move and not have anything against it, because you're going to lose a lot. So what I'll do is sell those and buy a put option further up the curve that inherently, if the market does drop 5, 10, 15%, then generally I'm hedged, and the performance of that.
And that's what you are expecting,
something
like that.
Yeah.
Alvin, thank you very much for joining us here on the floor of the New York Stock Exchange.